Great, just allowing a few moments for everybody to join us from the waiting area. Great, so I think we'll make a start. Well, hello everybody. Welcome to this Alliance Manchester Business School webinar. My name is Ekaterina. I think I've been in contact with quite a few of you. I can see from the names in the room with us today. I am part of a team responsible for the recruitment of talented candidates onto our array of MBA programs. So thank you very much for joining us today. The purpose of today's session is to give you all a taste of our MBA programs and some of the content that we deliver on the course. So we're very fortunate today to be joined by one of our leading academics, Malcolm Smith, who will spend the next 30 to 45 minutes just to give you a flavor of one of his courses that he delivers on the program. You will notice that you have all been muted and your cameras are off, and that is just to minimize disruption. This is very much an interactive session, and we do encourage questions throughout. In fact, you'll see that Malcolm will be insisting that you answer his questions throughout. So please do use the question and answer area for that purpose. After the main presentation, myself and my colleague Lewis will be staying online to answer any admissions related questions. So please do save those to the end of the session today. And just to remind you that the session is being recorded. So thank you very much again for your time and enjoy the event. Over to you, Malcolm.
Thank you, Ekaterina. Ekaterina and I have worked together over a number of years. Well, not that many because she's just very young, of course. And we really enjoy the interaction. And I'm sorry we're having to do this in a web-based Zoom scenario, but who knows, one of these days we'll get back to good old face-to-face banter. So I'm involved with two programs. I work with a gifted team of people on venture capital and private equity. And this is based on our VCPE course. And I also work with another gifted team on negotiation skills. And the fact of the matter is that our program tries to teach you a whole range of things which will improve your life skills as well as your corporate skills. And some of the stuff I'm going to talk to you about today may aid you in your thinking about your own investment decisions, although I'm not going to make any recommendations because that's a dangerous proposition, believe you me. So, valuations in the age of the digital revolution, and we really are in the digital revolution. It started, of course, in 1995 when the internet was allowed to go commercial. When it became really mainstream. And it's taken 25 years to gain traction, but it always does. I'm frequently asked, of course, in my role in the university, and also I work for venture capital and private equity, and I'm a non-exec of startups. And we're always trying to work out what something's worth. And everybody thinks, well, these are brand new, innovative ideas in the digital revolution. It must be totally different, mustn't it? Well, no, because I'm going to say this to you. Is there anything really new about the companies leading the digital revolution? Is anything really new out there? Or are we talking about developments of existing propositions? And I'm going to come up with some things you might find rather surprising, but these are views which have been formed thinking about the real things that drive valuations. I'm going to look at some current data on stocks that have just IPO'd at the end. It's going to be really current because it's going to be live data. And I'm going to talk about live today data from the stock market. And I'm going to talk to you about what's happened to the IPO price and how surprising these moves have been and what might have driven the moves in the price and their underlying metrics that drive valuations in these extraordinary times, because they are extraordinary. So valuations in the age of digital revolution. I was going to say, I look back to the Industrial Revolution to try and find out if there are any parallels. Because don't forget, digital is just the new industrial. You know, we do things differently now because we've all got this thing called a laptop on a phone, you know, the brain disease thing, this thing we all have that rules our lives and we've got to look at it every 25 seconds or the world will stop, you know, like TikTok garbage. So the Industrial Revolution was the beginning of mass production. And of course, the CO2, we won't go into that, but COP26 has highlighted the UK, of course, as being the bad boys because we kicked off the modern Industrial Revolution. And what happened at that point in time, we got the aggregation of capital resources to generate mass production and global trading of manufactured goods. And of course, at that time, the UK had an empire And we utilized our empire very much to expand our industrial base. And we were bringing raw material in from the empire and exporting finished goods out. That was the beginning of the predominance of the UK as the world's first industrialized country, of course. This is not me blowing the trumpet for the UK. It's a historical fact. Now, China might have something to say about what happened before the 15th century, and they have a lot to say about that. But in terms of modern industrial production, the UK led the way. So how were companies valued then at the time of the Industrial Revolution? Because that's when the stock started to trade, a bit different to today, but they did start to trade. And why is that relevant to today? What is the relevance of the Industrial Revolution to the digital revolution? Let's think about it. Whenever there's a revolutionary, in fact, disruptive change, then whatever you've regarded as a yardstick for value in the past is no longer really all that relevant because things have moved on. For example, what happened when you went to the car from the horse? Totally different ballgame. New metrics emerge and we start to see what works and what doesn't. And inevitably, when we start to value new enterprises, it's a bit of an approximation. And we're always trying to find a proxy for cash. Because ultimately, if you're not generating cash, what's it all about? And we try and find out what works, what doesn't. And over time, we get very good at working out the metrics that drive value in our different sectors. And we're really good at that. And markets are very efficient at finding appropriate yardsticks for value. So in any time of immense change, there's always one factor which is critical to success. And it means getting your goods to your target market. If you can't get goods to market, then what's the point in producing the goods? Because they're going to go to waste. So if any of you got any ideas, what was the really exciting stock in the 19th century? I know we're going back a bit before you were born, even before I was born, but in the 19th century, what do you think was the most exciting stock on the real go-go? You know, like the original 1920s. Everything was going crazy and people were betting the blooming farm on it. What do you think that stock might have been? Any ideas? Catherine, if you can shout out to me anything that goes on web chat, it'd be really helpful. Just some ideas that people might have.
No problem, I will. Cotton.
No, not that one. Only one idea so far. Come on, that was two now.
Standard Oil.
That was a bit before. So Ohio was the world's first.
Sugar, coal.
Sugar, coal.
Appliances, another coal.
Right, carry on. Come on then.
Labor, tea, rail.
It's rail. The means of getting your goods to market. Instead of having to take them on the back of either on the back of a horse or in a wagon, all of a sudden somebody invented the railway line, and it connected consumers to means of production. It also connected towns, and it completely revolutionized the world because people aggregated to towns which were near to railheads. And in fact, towns were almost paying to have a railhead because it changed the ball game. So railways, it not just took goods much more quickly, it took people from point to point. Now, there was a huge stock market bubble, which of course burst. Now, the real period of frenzy was actually 15 years, which is a long time for one stock. I mean, nowadays it's 15 months and things move on. The interesting thing was people were buying 10%, were putting 10% of the value of a stock down, promising to pay it later. In other words, it was a kind of a put option, hoping that the stock would go up in value and then they would make a load of money. Problem was when the stocks went down, they had to pay the difference, and that cost them a lot of money. So in 1845, when the bubble finally burst, because the true returns from railway were finally becoming clear, they weren't rubbish, but they weren't what people originally thought, because it's a highly capital intensive industry and it was sucking money in. So they couldn't pay dividends because they were sucking the money to put the lines on the ground. But of course, what became interesting at that point, the sort of cowboy outfits were all subsumed into consolidations, because any market starts out fragmented and then it consolidates as economies of scale become more important. Does this have any resonance for today? Of course it does. Think about the internet as a means of transmission, because that's what it is. The current goods which have real value are data. And the way you take data from A to B is on the internet. In those days, yes, cotton and sugar and steel and coal, they were important. But the thing that mattered wasn't the coal, steel, sugar. It was how you get them to market. And the way you did that was in some cases by a boat, of course, via canals. And that was another bubble, of course. And most cases, it was rail. And of course, today, believe it or not, Warren Buffett, the sage of Omaha, through Berkshire Hathaway, has taken a huge position in railways via Santa Fe Railways, because the means of transmission are even more important now than they were before, particularly in an age where you're trying to go to carbon zero, and railways have a large part to play in carbon zero. This could be a new age of rail. So there are messages from the past which we can use for the future. You could say the digital revolution started in 1971 when Kahn and Cerf developed so-called transmission control internet protocol. People often think it was a CIA-driven thing or military. Actually, it wasn't. This is a conspiracy theory of which there are so many today, it's ridiculous. And of course, the invention which really brought the internet to the masses was the first search engine, which of course was the World Wide Web, www. And this was invented in inverted commas by Sir Tim Berners-Lee in 1989. He was a physicist, he was working at CERN, he's of course English. And like us, we gave penicillin to the world and then we gave the internet to the world. Aren't we generous? And then sadly we gave MBAs to the world, but then again, you can't have them all. So Sir Tim Berners-Lee actually was the one who generated the first HTTP code, which then generated the World Wide Web. And then after that, it's all history, isn't it? Everything changed from that point on. And of course, one of the first and best search engines was Netscape, and they made a huge mistake. And then all of a sudden, they were subsumed into somebody else. There's been a lot of success stories which became not a success from the point of inception of a new concept. And this happens every time. And it's going to happen in the digital age as well. There's going to be a lot of losers as well as winners, because there just are. So we're moving on from the sort of the beginning of the 90s into then the next big bubble was telecoms. Because in the 1990s, we had things coming along called mobile phones. And when I first went to work, there wasn't any mobile phones, there weren't laptops. And if you were lucky, you had access to a mainframe. An IBM mainframe in those days was the name of the game. But in the 1990s, we started to get digital freedom through the mobile phones, and they were like bricks. The first one I had in 1986, goodness me, it was fixed to my car and it wouldn't go out the car. But all of a sudden, mobility. See, mobility is a theme throughout this, isn't it? The railways is about mobility. Mobile phones is about digital mobility. And this is the trend over the last 25 years. Digital mobility is the name of the game today. But how do you value, in the beginning, how did you value telecoms companies? Initially, it was just growth. So in other words, the more clients you had, then the more Vodafone was worth. And Vodafone was like worth, in today's terms, almost as much as Apple in its day. It was ridiculous. And it was buying other companies with its stock rather than cash, because its stock was overvalued. So at the beginning, we weren't too sure how to value mobile phone companies because there'd never been one before. So we thought, okay, growth's the only metric that matters. And then we got more granular because we started to realize it wasn't just growth. Well, how many companies in a churn, as competitors became more aggressive, all of a sudden people churned from one mobile company to another. And then ARPU, the average revenue per user. In other words, if you've got a mobile phone, yeah, if you spend £100 a month, great. If it's £9, not so great. And over time, ARPU for mobile phones has fallen as we move to access over the internet rather than via mobile phone telephony. Now, as I've said before, and now the companies themselves are largely irrelevant with the growth in voice over. And voiceover is where it's all at now. People like using WhatsApp or Zoom or Teams or whatever you want to use. Because mobiles themselves have morphed into something that they aren't. How many people actually talk on a mobile phone today? The young generation don't. Millennials tend to use texts, or obviously WhatsApp or Signal or WeChat or whatever, because it's not cool to speak to each other on a phone anymore. You've got to use some digital means of communicating. My son can actually send a text messages in his pocket with his thumb. So Nasdaq, how can you get to what makes sense in terms of valuations? Nasdaq, of course, is like the tech, if it's the place for all the high-tech stocks in the NYSE, New York Stock Exchange. It's a very useful metaphor for the growth in the value of digital stocks. If any of you invest money, obviously trackers are a big deal, very cheap way of investing in your monies in your pension. And trackers sometimes track a particular stock market. There's Nasdaq trackers, there's NYSE trackers, FTSE trackers, world indices trackers. And what they're trying to do is find a metaphor for growth. Now, Nasdaq's done extraordinary things as the digital revolutions gain traction, because of course high-tech stocks have all of a sudden, whoa. I mean, we've got Apple was the first $1 trillion company, then the first $2 trillion company. Now it's been overtaken by Amazon. I thought it might be interesting to look at Nasdaq, see if there's some kind of metaphor for value, and if there's a disconnect for these wonder stocks from the real world. So this is the Nasdaq annual growth. It only goes up to, well, it's reasonably current. And as you'll see, there's a couple of downturns there. 2000, of course, was when trillions was knocked off the value of Nasdaq, because that is the so-called dot-com bubble, which happened in the space of a few weeks. And the reason the dot-com bubble happened was that valuations were based upon an incorrect premise. And what was happening with the original web-based companies was that they were valued a number of clicks on their website. It wasn't even organic growth, it was just a number of clicks. I mean, those of you who know about Google Analytics, I mean, this is ludicrous, right? I mean, it's like out of the arc stuff. But in those days, nobody knew, because in fact, the web has only become commercialized in 1995. So 5 years on, we were trying to get to grips with, well, how do we value these companies in this new dot-com era? Because nobody really knew. We didn't have much of a clue at all. I mean, Amazon started in 1995, as did eBay, of course. And Amazon started out selling books out of a blooming garage. So things have moved on a bit since then, right? So what happens is, initially, if your means of valuation is wrong, then you have a crash. And it goes too far the other way, of course, because prices move in a pendulum, and it sort of swings far too far one way, then far too far the next. And therein lies an opportunity for value, ladies and gentlemen. But I'll come back to that. So the Nasdaq crashed in 2000, and it stayed crashed for a few years because everybody lost faith. Even though there was a business in there, people didn't know how to value it. And it took a long time to get investors to believe and trust in these stocks again. Something similar has happened in cybersecurity and in cryptocurrencies. We're in a very dangerous time for cryptocurrencies. A lot of money being made, but yeah, a lot of money being lost as well. So there was a gradual return to grace, and then over the 2000s, then it sort of flatlined. It sort of gained some of its stock valuation back, then it flatlined, then woof, 2007, 2008, the global crisis hit Nasdaq the same as anything else, because nobody knew what anything was worth when there was no money in the bank. And subsequent to that, the Nasdaq has tended to follow global GDP. And this is, in fact, global GDP mapped against Nasdaq changes. So Nasdaq is not divorced from global GDP, and nor should it be, because you know what? Digital companies live on the back of GDP generally. They are substituting and they are disruptive technologies, but if the whole GDP goes south in the world, then as it did in 2008, then look at what happened to Nasdaq. It's not divorced from the real world. There is a relationship between high tech and GDP. Of course there is. So when tradition, what has been replaced by digital logistics systems, and will this continue? Will the changes that we've seen in the last 20 years continue? Well, the short answer is yes. And I'll talk a little bit about what's happening today. So we've got the rise of SaaS, software as a service. Now, believe it or not, I found a new one this morning, ransomware as a service. And you know that ransomware is all about people camping out on your website and trying to destroy your company and then taking blackmail money from you. Well, there is a company called, there are companies in the ransomware as a service world which facilitate the transfer of monies to pay people off so they don't destroy your website. Pretty stupid thing to do, but it exists. Kind of surprised me that I've discovered that this morning. So SaaS is software as a service, and it's the equivalent of oil in the engine of the Industrial Revolution. You know, we're not excited about building cars anymore. Well, we are, but only electric cars, and I'll come on to Tesla in a minute. But if you look at the digital world, then software as a service is a facilitator, because you don't have to spend megabucks up front. Like in the old days when you bought a SAP system, you had to spend $250,000 before to get in the door, and then it was just like having a vacuum cleaner in your wallet. I mean, SAP was very good at extracting money from its clients. Now, all of a sudden, these new startups have come along. I mean, you've got people like Xero. You might have heard of Xero. You might have heard of, QuickBooks, all that kind of stuff. People are opening up the internet so that you can buy what you want when you want it, and you don't have to buy it all at once, and you don't have a big entry cost. And that's what SaaS is all about. Now, the biggest SaaS business today is of course, Salesforce, which began around about 1999. And of course, since then, it's become mainstream. And Salesforce.com is like a customer relationship management system, so-called a CRM system, but it's much, much more than that. And it was the world's first $100 billion valued SaaS business, and it'll probably be the world's first $1 trillion SaaS business. So how do you value SaaS businesses which sell things per month, and they don't sell goods? They sell software services, and they sell white label services. And if you want to make them very much more applicable to yourself, you do it yourself, because the tools exist for example, within Salesforce. You can sort of personalize it, but you do it yourself. In fact, they will help you to do it, but they will charge you for that. So you're buying a white label. So in other words, Salesforce sell the same thing every time to everybody. It gets varied a bit, but basically you buy the same thing every time. So software is not developed specifically for you. You're buying off the shelf. That's really important. So, of course, valuing young businesses is much more difficult than other ones because there's less predictability. In the words of sort of random theory, they're a mystery rather than a puzzle. In other words, there's no known algorithm which you can use or clear metric to give you a specific valuation, because you're dealing with the unknown. And some young startups really are a mystery. You don't know if they're going to work or not. And that's when it gets very tricky. The consequence of these young companies' lack of maturity is that we don't have EBITDA, in other words, operating cash flow, because it's negative. And we can't use discounted cash flow because they're meaningless when you're burning cash. So the old kind of metrics we used to use in the old mature business world of cash flow, assets, and all that kind of stuff are completely irrelevant. They don't matter. In the early days, people were saying, well, these businesses have got no value then, garbage. SaaS businesses are hugely valuable. It's about how you identify means of valuation. And I'm going to try and help on that now. So we do need to find a proxy for cash. So we can't use EBITDA DCF. So what are we going to do? What is the SaaS model? If you're an investor, you've got to figure out, what am I buying? So SaaS businesses essentially export their risk to their financial backers. And what they do is they use investors' funds to grow like heck. They're really growing really, really quick, because what they do is they spend all the money on acquiring new clients. And the reason why SaaS businesses are so attractive is they sell a white label product. In other words, the gross margin of an incremental sale is over 90%, because you're not building a new car to sell a car. You're taking a software solution off the shelf and shuffling it digitally to the client. So the only cost of transmission or the increased server costs. End of story, that's it. So, I mean, your really good SaaS businesses have got 95% gross margin on every new product sold. So every sale is like cash. It's almost like 100% cash. So in a real sense, revenue is a great proxy for cash. Hence, SaaS businesses, especially in the early days, are valued on a multiple of sales, not EBITDA, because it's negative, not profit, it's negative. You can't use DCF, revenue, because every increased sale generates net cash. The multiple, the multiple of revenue, for example, a typical low multiple for a SaaS business is between 3 and 5 times sales. A really high multiple, I'm going to talk about Slack, is over 20 sales. And it's based upon the quality of earnings and the projected and past growth rate. In other words, what's the prediction of growth? And is it predictable? And if they've done well already and they're big and they're still growing fast, it's worth a lot of money. Because at some point, these companies are going to stop burning cash, because if everything you sell, you're making 90% profit on it, then you're not going to be long before you're generating cash. So the perceived quality is related to a number of factors, but the key metrics are duration of the contracts. Obviously, the longer the contract, the more the company's worth because it's sticky. The churn percentage, in other words, how many companies leave every month, and that's a proxy for lifetime value. Cost of acquisition, so-called CAC, client acquisition cost, and how long. And the most recent iteration, the last 2 years, from the west coast of the US, they're looking at valuation on how long does it take to get that CAC back. The faster, the better. Growth rate is mission critical. You're looking for 50% per annum growth, compound. The expected growth of the sector, which is a bit of an estimate because sometimes you're replacing an existing analog solution, in which case growth rates are exponential, or you're into a new area, and I'm going to come on to that in a minute. And how's that going to grow? And of course, management record is important. Is this their first rodeo? Have they done this before, or is it brand new? Are these guys learning as they're going along? Dangerous. So, given that we've now got the proxy for value, which is revenue, so we've got to look for mitigating our risk as an investor. So if you buy a share, for example, an IPO, or you're a venture capital company, you've got to look for something that looks like what you're buying to give you some indication of the likely direction of travel. So you look at deals that have taken place in the sector. By the way, there's nothing new in the world. There's always something that looks like a new thing. There's nothing new. They're just variations on a theme. One of the critical things, and this is, I'm going to show this in a minute, ridiculous level of appetite for risk at the moment out there, because this year is the biggest year ever for IPOs, biggest ever, and I mean ever. And that's because the investors' appetite for risk has changed. And the reason is very obvious, that you can't put money in the bank. You're going to get nothing for it. Interest rates are historical lows all around the world. And if they're high, it's because huge risk. So I'm not really excited about that, am I now? So what people are doing, they're trying to find places to put the money to generate better returns. Now, this is portfolio risk. Of course, you don't put all your money in this sector, but you put a chunk of it in this sector, in fact, trillions. So the appetite for risk, which is impacted by alternatives in the marketplace, will materially impact acceptable pricing. There's also this wonderful thing called FOMO, fear of missing out. If you want to look at that, think about Coinbase, think about Bitcoin, think about Doge, all these dodgy blooming coins that are out there, people making fortunes, losing fortunes. Fear of missing out on the next wave is a key factor in investors. And you've got to be careful as an investor, you don't get carried away by this nonsense. So you can't use conventional pricing models. You've got to use proxies for valuations, and you've got to look at a valuation metric which allows you to triangulate on a price. So you've got to consider your own risk profile. What are you prepared to accept as a risk? You've got to look at recent deals in the sector, and if possible, look at listed companies that look like what you're doing or what you're investing in. A so-called football field of valuation. So let's look at a couple of examples now. because it's rather than talking about academic stuff, let's look at what really happens in the real world. In December of 2020, Slack was purchased by Salesforce for $28 billion effectively in cash and stock, mind you. There was a lot of stock in there because Salesforce's stock is well priced. This is a pointer to the future of digital enterprises. The combination will create the operating system for the new way to work, uniquely enabling companies to grow and succeed in the all digital world. This was the words of the CEO when they bought Slack. In other words, he couldn't figure out what it was worth, so he put his finger in the air. Let's be honest about it. However, clever lad, worked. In 2020, Slack's revenues were $900 million. So there was a massive revenue multiple of 31 times. So Salesforce paid 31 times the revenue of Slack. Was this a good deal? Revenue growth was 43% year on year, which is huge for a $900 million company. So looking forward, the revenue multiple could have been seen as between 15 and 18 if you project growth forward. With a gross margin, don't forget gross margin's high. In Slack's case, it was over 85%. And don't forget that stock from Salesforce was a factor in the purchase, and that's already highly priced. It's likely that on an earnings per share basis, the purchase of Slack, believe it or not, will be accretive in year one for the purchaser, which is why people use stock in an acquisition of a go-go company. Salesforce's stock since then, in October, I haven't looked at yesterday's, I'm sorry, up from $202 in January to $275 a share in October. Now, come on, that's not a failure. So now we're going to talk about IPOs, which is really exciting. The valuations of IPOs are truly staggering, because COVID, of course, has done one thing. It's accelerated digital logistics, digital solutions by an unbelievable amount. My son works for one of the world's largest retailers, and I won't mention them, and he's in a very senior position in their finance team, and he said that their digital sales grew by 10 years equivalent growth in 6 months. So they had 10 years of growth in 6 months in the beginning of COVID. And guess what? It isn't going backwards. Because once you've found a better way, you don't go back. Cryptocurrencies, of course, capture the imagination of all greedy people. Of everyone, I should have said. Everybody wants to get rich quick. And a lot of people investing in cryptocurrencies haven't got the faintest idea what it's all about. Then you've got DoorDash, of course, really awful. I mean, if you talk to anybody in the US, they're not great at delivery. They were founded in 2013, lost money consistently, and floated in December 20 at $33 billion. Coinbase, founded in 2012, basically trades in cryptocurrencies. Kind of interesting idea, because it's a great idea, platform for trading in go-go whizzy currencies, and floated on April 14, 2021 at a value of $86 billion. Been interesting ever since. IPOs in 2021. In the first half of 2021, there were over 1,000 IPOs, raising $220 billion. Since then, it's over nearly 2,000, raising $350 billion. So I've just updated that yesterday. It's a ridiculous rate of growth because, frankly, there's nowhere else to put your money. And this year will, and it already has broken, records for IPOs globally. And the reason is, where else are you going to put your money? And also, this is the age of the digital revolution. It's come of age. And so all these ideas which were in the background being serviced by venture capital, private equity, they're releasing it onto the market because VCs and PEs know when to sell things. They're very sharp. They're very clever people. When the market's hot, let's put the pan in on the griddle. Now, don't put the pan on the griddle when it's cold. Wait until it's hot. So let's talk about some common sense pointers to value, because common sense, believe it or not, does matter. So it's all about finding a more convenient and cheaper route to the market. Amazon's a great example of that. Alibaba's and also a great example of that. Easy to understand models are really important. Uber's very easy to understand, gains traction because all you know what you're doing. You're digitally hailing a taxi. It's not very complicated. Of course, they're equally rapidly attacked by Me Too, such as Lyft. And of course, this all around the world. There's people now attacking Uber because it's not that difficult, really. Once somebody's figured it out, it's not that complicated. The idea is great, but it's not that difficult to replicate. Social platforms are great, but there can only be one dominant platform. Very interesting. It's not like Uber where you suddenly say, well, I'm going to use Lyft or whatever I'm going to use locally. The bottom line is, once you've got traction on a dominant platform, a social media platform, it's difficult to knock them off. For example, look at WeChat, how big that is in the Far East. You're not going to knock that off its perch. There ain't going to be another WeChat. In the West, we've got WhatsApp, of course, bought by Facebook because they wanted to be a part of this digital revolution. They wanted part of this. They paid $17 billion. They're not quite sure why they did, but they've done very well. Instagram, they've made a fortune out of the purchase of Instagram, and Google, or Alphabet now, made a lot of money out of buying YouTube. But WhatsApp, well, we don't know what's going to be the outcome of WhatsApp. They're trying to monetize it now, but of course, the problem was the founders left WhatsApp as soon as Facebook tried the usual games. By use the information from WhatsApp. I'm sorry, they were trying to use your information, and the founders left and formed Signal. So basically, there are some things which are easy to replicate, but once you've gained first mover advantage, it's hard to shift them. Very hard to shift them because you've got position, you've got the space, you've got your tanks on the lawn, and that applies to WhatsApp and WeChat. So I'm going to ask you all a question now, and then I'm going to show you a couple of recent releases and try to identify what's happened and when and why. So fast forward to the 2020s. I'm going to ask you, clever people all listening to this now, what do you think will be the growth sectors of the next 10 years? You put it on web chat, and then my good friend Katerina can tell me what on the chat version. She'll tell me what you're thinking. So a couple already.
Yeah. AI, 2 for AI, 1 for automation, clean energy, space astronomy, health, another AI, metaverse, genetic engineering,
right,
automated transport,
yeah,
fintech,
yeah,
health sector, water.
Water's the new oil, of course. Yeah, yeah. Okay. None of you got the most important one yet. The one that's going to be very dominant. Any idea? Any new ones?
No, more of sustainable energy and space.
Of course, COP26 has affected people's mindset. So they're all thinking about sustainable energy and green technology, which of course are hugely important. I've put 3. But there might be a 4th, and one of you's mentioned the 4th. So the 3 I've got, and one of them none of you's got, and it's very obvious in the digital age. I'm going to give you all 20 seconds. Can somebody think of an obvious company, the type of company is going to be huge in the next 10 years because of the digital age? Any idea?
Data.
Data is very important, yeah, but that's not what I'm looking for.
Digital currency.
Yeah, blockchain. Blockchain's important. I'll come back to that.
Telecoms.
Okay, you've had enough time. And this is it. Cybersecurity, ladies and gentlemen. Cybersecurity. In the age of digital revolution and data transmission, where data is hugely important and artificial intelligence is hugely important, cybersecurity. Because if you aren't secure in your transmission of data, then you're dead. Every company today is spending more money on cybersecurity than they have ever spent in the percents of turnover. And the more digitally aware you are and the more digitally connected you are, the more that percentage will be. Because if you do not secure your data and you do not secure your systems, then nasty people from nasty places controlled by governments, allegedly, will in fact involve ransomware to try and steal your data and block your systems, and then try and very hard to get you to pay a ransom. For example, recently you may have read about the case, a very famous ransomware criminal gang, allegedly based out of Russia, but I don't know, that stole all the information about one of the world's famous jewelers, and then gave people information about the people who were spending all this money on jewelry in the COVID epidemic. Then, only inexplicably, days later, this same ransomware bunch of criminals posted an apology to the Saudi royal family. I thought that was very interesting. I think they probably really would, because the Saudi royal family has got more than their government. And the Saudi royal family have basically said, if you carry on doing this, there will be repercussions, ladies and gentlemen. So anyway, that's a lovely example of cybersecurity in the current age. But if you do not protect what you've got in the digital age, it will be stolen, and you will find yourself closed down overnight. And then somebody's going to come along and say, I've got an offer you can't refuse. So number one, cybersecurity. Green technologies, of course, key issue. Healthcare, people mentioned healthcare. By the way, AI is just basically a tool that we use to do something else. And it's in and of itself, it's irrelevant. It's how you use it. So companies that employ artificial, or more importantly, augmented intelligence, are going to be really whizzy, because they're going to have algorithms which generate real value for their shareholders. So yes, green technology is important, and the use of AI, in particular in healthcare, is the biggest, sexiest thing in the VC world in the West Coast of the US today. Because what we don't want is people looking at your cancer smear. What we want is a machine doing that, and not going on holiday, not getting sick, not having a problem with his eyes or her eyes and making a mistake. What you want is a machine looking at your data and giving you the right answer every time quickly. So actually, in IPOs, healthcare companies are very, very prominent. Very high percentage of new IPOs relate to healthcare and related issues. Gene technology, for example, Oxford Nanopore, a recent one in the UK, very related to healthcare because of its gene sequencing abilities. And healthcare is about gene sequencing now. It's no longer about somebody, knocking you on the knee with a hammer to see if your reflexes are working. Those days are gone. That's all moved on now. Shortly, we're all going to plug ourselves into a chip, a bit like cars do, and we'll be able to say everything that's wrong with you. That'll happen within 10 years. So healthcare is going to basically be revolutionized, because we all want to live longer and be fitter. And we're all getting older. The world is getting older. So healthcare is numero uno in terms of big money, because there's an infinite demand for healthcare, infinite, because we all want to have our hips fixed, our knees fixed, our eyes fixed, our teeth fixed, our nose fixed. We want things fixed, and we're prepared to pay big money for it. Now, I put the metaverse, one of you mentioned the metaverse, I put that in for a joke, really. Of course, Zuckerberg, that genius of Facebook, has made all these comments about the metaverse. We will see. And there's no doubt about the fact that a lot of people live in the metaverse now. A lot of kids spend half their life, stupid fools. No, I shouldn't say that, because it isn't true. I think they're stupid fools, but that's because I'm old. I think it's crazy to spend your life in a universe where you're just playing with keys on a laptop and not actually conversing with other people, because that's not very exciting to me, but maybe I'm just old. So the fact is, the metaverse is a big deal. How it can be monetized, although there are virtual shops, as you all know now, out there on the metaverse. It's going to be big. How big it's going to be, I don't know. It's a function of whether people are prepared to immerse themselves in this. Who knows? It's definitely there. But I'm thinking cybersecurity, green technologies, healthcare are the areas which and obviously I would also include blockchain in cybersecurity, because of course cryptocurrencies rely on blockchain, and blockchain is a fantastic way of securing your data. It's a marvel. I mean, the guy who invented Bitcoin, or the group who invented it, blooming genius, of course. And blockchain will become part of everything we do. It's really good at protecting and managing data. There's somebody mentioned something in the Q&A. Katerina, is there a question on there?
One moment. Hi, Malcolm. Do you think that companies that currently have announced activities in the sectors that you mentioned already reflect most of the value of the growth opportunities in their market cap?
Absolutely not.
Or this could be beyond anyone's expectations?
Absolutely not. I think it's beyond anybody's even imagination. Let me show you one or two examples, if I may. I'll stop sharing, I'll share again. I was playing about this morning, because I must admit, I invest money myself in my own pension. And of course, to me, my pension is important, maybe less important to you, but I'm getting a bit closer to the point where it's important to me, right? So I spend a bit of time on this area. Let's have a look at Tesla now. There we go. This is Tesla stock over the last 6 months, year to date, 5 years. It isn't 5 years old, of course. Started out at $39, stands at $1,050 on the 16th of November. Now, this is an interesting one. This company is valued at $1 trillion, right? And it produces, I don't know, 600,000 cars a year, something like that, going up towards 1 million. You know, a lot less than the big car operators, but like just leaves them for dead, right? This company, and the clever thing is, and of course people say, oh well, of course our friend Elon Musk affects the value on Twitter. Yes and no. He has transient effects upon the valuation. The lovely little stunt he pulled recently of saying to his Twitter followers, should I sell stock because I owe $10 billion? Well, yes, you should actually. And of course he did. He sold $10 billion worth of stock gradually. And it hasn't affected the valuation. Very clever technology and thinking. This guy's a blooming genius, don't forget. He didn't upset the market. He actually made it a market issue. Really clever. Is the company worth $1 trillion? Yeah, it probably is, because it represents the new wave of manufacturing. It's got that cachet, it's got the brand, and of course, it's got a lot of technology in there. And there's a lot of stuff happening around that technology. But the Tesla company, really clever thing they did was they had a script. They split the stock into 5. So it made it more, you know, when it was up to about $1,000, they gave you 5 for 1, and everyone was worth $200. Made it much more tradable. Apple did the same. Very, very smart. They drove acceptance of the stock by making it more universally available and not so expensive per unit. The things that drive the real value of this stock are the acceptability of the product. And of course, the fact that today people are trying to get off hydrocarbons. So there's going to be a fantastic market for these cars over time. But this is only one supplier. Now, the fact is, you've got other suppliers in different parts of the world. And of course, in China, you've got some great examples of electrical vehicle companies, as indeed you have in the West generally. But this company's got the name. It's kind of got its tanks on the lawn. And Musk himself is a driver in the value of this business. No question about that. No question about it. It's an iconic figure. It's a bit like the genius Steve Jobs, who created the digital revolution in 2007 with the iPhone. So the valuation of Tesla is largely related to underlying factors. So in other words, the huge growth in demand for electric cars, and their technology is very good, of course. And also the incredible person driving it. And people believe he's going to continue to innovate. And they believe it's going to continue to grow, which is what's driving the price. The price earnings ratio is 342, which, if anybody knows anything about price earnings ratio, is right off the charts to the point it's out the building. Now let's have a look at another one. Rivian. This is just IPO'd recently. Now, the fact of the matter is that Rivian is in fact a business that makes trucks. Now, there's some doubt about how many it's going to make, but it says it's going to make 1,200 trucks a year originally. And it's valued at $146 billion for a company that's forecasting making 1,200 trucks this year. What? Well, the real issue is here that in the days when people are buying digitally, logistics are everything. So Amazon's a logistics company, really. It's hugely valued, more than Apple now. But you've got to get something from point A to point B. You can't deliver everything by drones. So you've got to deliver it by trucks. We can't have diesel trucks. We can't have petrol trucks because of COP. So we're going to have electric trucks, and Rivian is going to produce electric trucks. And now Rivian is valued at a huge price. We will see if it's working, whether it's going to be worth this over time. But the reasons for it being worth the money it is are quite logical, which is that we're going to deliver by truck because you can't do much else to get to someone B2C as opposed to pick up from a local depot. But even if you pick up from a depot, somebody's got to deliver to the depot. And this is why electric trucks are really exciting, because people see Rivian as a metaphor in trucks for Tesla and cars. There's another question there, Katerina, if you'd be so kind.
Hello, Malcolm.
Yeah.
Was there a giant company like Alibaba? You can't really define which kind of company is considering it contains so many divisions, and how do you value this kind of company?
Well, that's a good question. Alibaba, of course, fascinating business, is actually a bank. It's a huge bank. And it's got, if you said to me, what does it look like? It looks like Amazon. It's like because don't forget they invented the sort of singles event in November. They've done all sorts of clever stuff with Taobao, and they've got within Alibaba, you've almost like got a universe, which includes virtual stores and all sorts of stuff. But Alibaba is, if you said to me, what does it look like? It looks like Amazon. It's got more than Amazon because it's also got B2B, because it allows people to source B2B. But it's very much a platform. It's a platform sales organization. So you've got to compare it with other platform sales businesses. And you've got to figure out that you've got to be granular about its revenue. Where's its revenue coming from? Where's the drive? This is why when you look at Alphabet, you've got to look where the money coming from, for example, in Google. So you've got to look at the revenue streams and see how sustainable those streams are with Alibaba, which is now, of course, an existing company. Because Alibaba saved a SoftBank, as you know, because that was the biggest single bet. And they also saved Yahoo, because Yahoo owned about 17% of Alibaba, and that saved Yahoo from going down the pan. So very interesting. Those people who got into Alibaba early, who saw it as the Far East version plus of Amazon, did really, really well. Don't forget, a lot of stuff in the West is also replicated in the East, because WeChat is really WhatsApp, but large on steroids. It's actually better because you can transfer money, and it does all sorts of clever stuff. The only problem with WeChat is it's not secure, and whatever you do in WeChat is being watched. I shouldn't have said that, but it is. So let's look at another one, which I'm excited about. Darktrace. Now, this is a company which is basically all about defending people against cyber attack, and it's looking for things that look a bit odd. Now, it started out at a fairly low cap when it was floated, because 16% of the shares is owned by a guy called Mike Lynch, and Mike Lynch and his wife actually owned the 16%. And Mike was the CEO of Autonomy, which was sold to Hewlett-Packard years ago. And of course, there's this huge court case about over-reporting of revenues. And the previous CFO of Autonomy is in jail in the US. And they're trying to get Mike Lynch extradited to the US from the UK, because they want to try him in the US for all sorts of spurious claims of things he's supposed to have done wrong. But because he owns shares in Darktrace, which is a fabulous company, the IPO almost bombed. It did nothing. Normally IPOs do this when you first IPO. But in fact, it grew and grew and grew as people became aware of the real value of the company and decided to ignore the detritus from the fallout from Mike Lynch. And then all of a sudden people started thinking about what it did. And it's kind of a whizzy cyber company. And then all of a sudden, when it got to 985 pence, there was a report by an analyst that said, hang on a minute, I don't believe all this, it's a load of hype. And he spoke to 15 clients who then said, yeah, well, it's not as good as they say it is. And then all of a sudden the price tanked, and then it's down now to 549. We'll see what happens next. But perception affects valuation is what I'm trying to show you here. The perception is, well, Mike Lynch is involved, so it must be wrong. Then people started to think this could be great. And then people started to say, hang on, it's not done what IPOs normally do, which is double. Let's make it double. The market goes for it, and people buy into that concept. Then somebody starts to say, hang on a minute, let's look at the real value. And then this is what happens to new companies. People's metric for value changes, but sentiment has a part to play in it. There's another question to Katerina. Yes.
How do you distinguish between different platform businesses, assuming all platforms are technically stable and all are virtually managed marketplaces, and find which is best bet for future business model and good investment?
Well, once again, look, there's only one Alibaba, there's only one Amazon. There ain't going to be another. So if you're looking at, like, I'll give you an example of what Shopify is the one you might want to look at. That's sort of interesting. Ocado is another one. It's a kind of a platform sort of thing. You've got to look round about a big platform like Amazon and think about things that maybe feed off it, and then look at what their business plan is and what the potential growth is. But this is a very much a professional investor's view. So you've got to be careful. If you're going to, don't try and do all this for yourself unless you know what you're doing. But you've got to figure out what's the likely trajectory of growth. But most importantly of all, we teach you a thing called investment hypothesis, and we teach that on the course. And it's fundamental to understanding the value of any company. And unless you join the MBA, I'm not going to tell you what it is. Sorry about that.
That is correct, Malcolm.
So as far as I'm concerned, unless there's any questions, which there may well be, I've said my piece. I hope I haven't bored you. I've tried to give you really current stuff. I've tried to give you stuff from under the bonnet and tell you like it really is, as opposed to what it says in the textbooks. But I'm happy to take any questions as well from the floor if there are any further questions.
Thank you, Malcolm. Yes, we'll just give the participants just a few moments to type any questions. Again, please feel free to use the Q&A area if you do have any final questions for Malcolm. And of course, if you do want to see more of Malcolm and other amazing academics like him, then Lewis and I will be staying behind to answer any admission questions you may have.
Yeah, we're very fortunate with our professors. We've got a very, very gifted bunch of professors. Kevin Jagiello is an absolute genius. Then we've got people like Reza. Reza is an amazing guy. I can't even say his second name because I'm not very clever at stuff like that. Then we've got, we've just got a whole bunch of people out there who are really gifted. And I feel very fortunate and privileged to be a member of the team. I'm, of course, the most stupid member of the management of the team of the academics. I'm just a guy who does things for a living. And they're much more intelligent than me. But nonetheless, you're going to get a very different view of the world when you come to join our MBA. It is not like you think. It is not like it's going to be out of a book. It's not like reading a book on accountancy, because it ain't about accountancy. If that's what you think it is, better not come, because it's a bit more exciting than that. So somebody's raised their hand here.
Oh, I like this one. If you had to invest in a new company, which one would it be and why?
A new one?
Well, new inverted commas.
Well, I'm looking at 3 at the moment as a matter of interest. I invested already in Dark Trace. I've had a great deal of fun. I made a lot of money, lost a lot of money, which is part of the game. And you've got to live with it. Never invest money you can't afford to lose. First rule of investment: don't invest if you can't afford to lose it, because that's not a good idea. Yeah, I'm excited in companies like Dark Trace. I'm excited about companies like Rivian. I'm really looking at companies which are solving today's problems in new ways. But I mean, these are just my views. I mean, there's loads of stuff out there that's really exciting. And some of my friends and I have little investment clubs, and we play about for a bit of fun, really, And at the end of the day, think of it as fun. Do not invest your money unless you know what you're doing, because you're going to lose it. A great friend of mine, who was one of my partners, who was 94 at the time, loving, clever guy, sadly he's passed now, had a great life. He said to me, Malcolm, I can tell you when to buy, but I can't tell you when to sell. And the hardest question of all is to know when to sell, when you've had enough. I made that mistake in 950 with Dark Trace. I bought them about £4. I let them go to 950, and my son said, you better sell them. I said, no, they're going to go to 12 quid. Oh dear. Moving on. We all live and learn. That's why I've got white hair. I worry a lot.
Great. Well, I think we'll leave it there, Malcolm. Thank you again so much for your time today and for everybody's participation. So you are free to go. Lewis and I will be staying behind everyone to answer any admission questions that you may have. So thank you again, Malcolm.
Thank you for your efficiency as ever, Katrina and Lewis. Really great. And you've got a great number of people there. It's good to see. And I'm sure everyone's going to enjoy what you've got to say. And don't forget, you can't find out what's beneath the bonnet unless you join the MBA. I'm going now.
Wise words. Thank you, Malcolm. Great. So again, please feel free to use the question area. So Lewis, my colleague, as you can see, has joined me, and we'll be happy to answer any questions you may have about any of our MBA programs, any admission related questions. Just a bit of sort of a snapshot in terms of future intakes we've got coming up. So we are accepting final applications for our January intake of the Manchester Global MBA and the Executive MBA program. And we're also accepting applications for our full-time MBA, which will be starting in September next year, as well as the Kelly Manchester MBA starting in July next year. So quite a few programs to cover. So please feel free to ask any questions about any of these 4 courses. Great, so we've got a first question about scholarships. Mudassir, you said you've applied for the Manchester MBA. I presume it's the full-time program you've applied for. So we do offer a generous range of scholarships for the full-time MBA program, ranging up to 50%. Some, well, in fact, most of the scholarships you don't need to apply for separately, so you'll be considered for automatically. However, we do also have some specialist scholarship categories, and we do encourage you to have a look on our website, because some of the scholarships may require additional essays to be submitted alongside your application form. So again, if you go on our website under fees and scholarships, or fees and funding, there will be detailed information about the different scholarships available and how to apply for each of the specialist categories. I got the easy question, Lewis, so hopefully you get the next one, and it's really hard.
There's a few coming through.
Oh, here we go. You can take the next one.
Okay. Oh, there's quite a few. So yeah, so I'll take the GMAT one. So for the full-time MBA, we do require, for you to be eligible to apply for the program, we do require a valid GMAT or GRE. Now, we do encourage also for individuals to reach out to us, you know, to assess your profile. And in terms of waivers, there are some waivers available. So we can, again, you know, we can do that on more like an individual basis. So we will be following up with everyone following this session in terms of reaching out to you. So you have our contact details. We're happy to set up, you know, one-to-ones and talk more in depth about potential applications on either the full-time or our professional MBAs. But for our professional MBAs, we don't require a GMAT or GRE, and you can apply with over 6 years experience without a GMAT or GRE. So we have our own internal test for that.
Great, and just to follow, excuse me, to follow up from that, somebody was asking about our average scores. So our average GMAT score for the last classroom was 660. But as Lewis said, it really does depend on your profile in terms of what score you should be aiming for. If you are somebody who's taking the GRE instead of the GMAT, then there is a very helpful conversion tool that you can use online. And basically what we're looking for is that your GRE is comparable to a GMAT of 600 plus. So that's what you should be aiming for. Requirements for the full-time MBA. Again, I would recommend that you have a look on our website. There is actually quite a long list of entry requirements, but essentially what we're looking for is well-rounded professionals. So although an average in terms of postgraduate professional experience on the course is 7 years, what we're looking for ultimately is a range of achievements. So you need to be an individual who has progressed in their current role, maybe somebody who's moved companies or somebody who's worked across different sectors or countries, and somebody who has experience of management, you know, whether it's managing teams, projects, budgets, somebody also who may have been recognized by their company. So we are looking for those individuals who can list their achievements in their application form. But like I said, do go back on the website and have a look at those entry requirements in terms of applying for the program. Opportunities for study loans. I'm not sure, Stacey, which program you're inquiring about, so and where you're based. There are no, in terms of study loans, we don't actually work with any finance organizations in terms of provision of study loans. We do work with a company in terms of full-time MBA fees called Lendwise. And again, you will find their details on the fees and funding pages of our website. If you are somebody who's based in the UK, who's thinking of applying for one of our professional MBA programs, then you may be eligible for a postgraduate study loan provided by the UK government. And you can just Google that and you'll come up. I think it's up to £11,500, so that's the value of the loan. But that's sort of the range of loans that we've got available.
Zihan said, if I'm already starting an application, should I schedule a one-to-one profile review with you guys? Yeah, we're always happy to help, and obviously to look at people's profiles. We, again, like I mentioned a little bit earlier, we will be reaching out to everyone following this event. So yeah, do feel free to get in touch with us. Even if you started your application, we're happy to schedule a call. We might be able to answer some questions that you have about the program as well as the application. So yeah, we were very much encourage that.
Great, and I think we've had 2 or 3 questions about what's happening now in terms of face-to-face study. So face-to-face study has completely resumed. So the full-time MBA students that started, I'm trying to think now, in August, at the end of August, so they've started all their classes face-to-face. And also in terms of our professional MBA courses, so that's when students come on campus for their workshops every 3 to 4 months for about a week. Again, those have resumed face-to-face. Of course, we don't know what will happen in the future. We can't, of course, prevent any local lockdowns imposed either here in the UK or in any of our campus locations. But we always have contingency plans in place to ensure that your study is as uninterrupted as possible. But at the moment, everything is back to face-to-face and may continue.
Dan's asked about cohort sizes. So again, not sure which program you're referring to, but I'm assuming with the follow-up question, it was about average salary. It's the full-time MBA. So for our full-time MBA, we have 1 intake per year, and we recruit around 100 to 116 students. On our global program at the Manchester campus, we recruit for 2 intakes, January and July, around 70 to 90 students per intake. But across the whole program, which we run out of all of our campuses, you're looking at around sort of 400 to 600 students. So very, very large program, very large network of individuals. That's to give you a bit of a flavour of the different programs that we have in the cohorts.
Oh, right. So there's a question for you, Lewis. Just to clarify, Lewis hasn't done the program. You obviously look like you have completed the MBA, because Masahiro is asking you what your most rewarding moment you've had so far. But
it does say AMBS Live, to be
fair. Correct.
So yeah, no. So I'll just give a bit of a reflection on, obviously, myself and Katrina work at the business school. It's a great place for us to work. In terms of, it's even reflective in the staff that we have in the recruitment team, in the marketing recruitment team, and the admissions team, and the academics. Speaking to Malcolm before, obviously he's UK based, but there's a huge amount of internationalism just within even the teams, let alone within the cohort. So you're going to be learning from people from all over the world, and it's the same for us as well in our team. And we pre-pandemic, obviously we do a lot of meeting individuals around the world. So another great thing that we do in our team as well. But yeah, unfortunately I haven't done the MBA yet. But if I wasn't in this job, I definitely would be doing an MBA.
Great. And Sarah, I know we have spoken, so hi. I know you're asking a question about payment deadlines. As you have applied, the best thing to do is to speak to the admissions team directly. So you are somebody who is seeking funding from their employer for the professional MBA. So if you speak to the admissions team directly, there may be some leeway in terms of moving dates slightly, just to allow you additional time to get that business case through. So please do email them directly. If you haven't got their email address, if you just drop me an email, and I will get back to you with their contact details.
Megumi's asked, following the program, what is the work license? So yeah, so the post-study work visa that you get following the full-time MBA is a 2-year post-degree. So you've got 2 years to live and work in the UK following your degree, before you'd have to obviously either be sponsored or move back to your own country.
And then a question from Jing just about alumni discounts. So yes, we do offer an alumni discount of 20% off the course fees across all of our MBA courses. And no, you don't need to apply for it separately. You will be considered automatically just by the virtue of specifying the fact that you've studied at the university or at the business school previously. Any final questions?
I think everyone's questioned out.
I know, I think so. So I think you've covered the cohort questions. So yes, I think that's it. As Lewis mentioned, I will be following up with all of you after the session. You'll also have access to a recording to watch in your own time. And please do feel free to reach back with a copy of your CV or resume. We'll be more than happy to schedule an individual chat with either me, Lewis, or another member of the team to cover your profile and best suited study options, available scholarships, and guide you through the admission process. So we do look forward to hearing from you. And thank you again for your time. Thank you, Lewis.
Thanks.
Thank you. Bye-bye, everyone.
Bye, everyone.